Hey, ballers! Happy New Year! It's like that Michael Bublé song. It's a new day, it's a new dawn. So if your 2021 was a bad year, hit that reset button. If your 2021 was a good year, let's make it a better year. So in the past few weeks, I have run into many of you and received many compliments about the show. So thank you so much for your support. I will ask for a little bit more from you this year. If you enjoy the show, please rate us, review us, share us with a friend. That's the only way you can help to spread the word to reach others who want to get into real estate or want to step up their real estate game. So for our 2022 season premiere, I invited my mentor Eddie Gant on the show. Eddie is often referred to as the GOAT of single-family residential real estate investing. So he's been buying ugly houses before HGTV made them cool. Needless to say, he's seen some crisis in the real estate investing space. So today on the show, we want to discuss what's up ahead in 2022. But first, let's get to the intro. Hey ballers, welcome to episode 126. Our first one for 2022 with me is Eddie Gant with Jet Lending. Hey Eddie, thanks for being here today. How are you?
Good afternoon. How are you?
I'm great, thank you. So how many houses have you bought, Eddie?
Do you really want to go there with that big of a number? That's a joke. That's a joke. I am somewhere just north of 1,700.
That's amazing. So I'm sure that you have maybe borrow money to buy them or use your cash to buy them. Have you ever heard of this company called Jet Lending?
Yeah, we've known about them now for 18 years. That's a great outfit.
Yeah, I've heard many great things about them. So can you go ahead and give the audience an introduction of who you are?
Yeah, Eddie Gant, based in Houston, Texas. I left my corporate job, I guess, June of 1999. Basically, within a few days, I was in the flipping houses business. And as I like to say, I was flipping houses before flipping houses was cool. Kind of like the old country song, I was country before country was cool. But anyway, we started flipping houses and we did it in a big way and did for years. And we started Jet Lending to start the loan funds for other investors in January of 2004. So we were in the house flipping business, the real estate investment business for 4.5 years when we launched Jet Lending. Myself, Debbie, and Johnny Hayes, my partner, we jumped in it in January of 2004 and haven't looked back. We've loaned quite a bit of money to real estate investors in Texas since then.
Yeah, I heard words on the street as Jet Lending is probably the biggest lending company here in Houston area.
I would say, I don't have a spreadsheet or a data sheet or a report I can throw out on your desk today, but just from the knowledge I have of my competition and what's kind of interesting, most of the competition for hard money lending in Houston, we're all pretty good friends. We actually get along very, very well. But I would say Houston-based residential hard money lending, Jet Lending is probably the biggest hard money lender in Houston, most likely.
So do you know that we are actually recording a season premiere for 2022 today?
I did. I believe you briefed me on that. It's been a while. It wasn't this morning. It was a few weeks ago. You were giving me the outline I need to keep myself in check and make sure I knew what I was talking about.
Yeah, so Eddie's being a little modest right now, but for the audience who has not heard of his name, I'm sure there's very few of you out there. Like I said in the intro, he's what some people refer to as the GOAT of real estate investing. So today I thought it was a great reason to invite Eddie on the show so we can talk about what's up ahead for 2022. For those of you that maybe dibble-dabble into real estate or, wanting to step up your game. So Eddie, let's talk about 2022. What do you think?
Well, I had the opportunity recently at a big real estate convention to listen to 3 different economists speak on exactly this subject, 2022. They all vary a little bit in their overall numbers and their overall ranges of where things are falling. But they all three, the consensus is for 2022, and this is going to be boring for your podcast, but it's going to be more of the same for 2022 that we've experienced in 2021 and 2020, meaning a very robust sales environment. Houses are going to fly off the shelf. They've been flying off the shelf. I looked at the stats yesterday for Houston, what's going on, and we'll touch on that a little more in a minute. But more of the same, sales are going to be plentiful. They're going to move fast. Inventory is going to be low. Interest rates are going to remain low, which is when you combine low interest rates and a small amount of inventory, it doesn't take a rocket scientist or a whole bunch of economists to figure this picture out for a little bit. And what they're all saying is it's going to go for a while. They're predicting even beyond 2022 more of the same. And it all centers around the most simple economic lesson we've ever heard, and that is supply and demand. There is low supply and high demand for housing, single family housing.
Yeah, so we've been hearing that since for a while, right? That there's a shortage in supply. Builders are not building and they cannot really afford to build affordable homes. You agree on that?
Yeah, that's right. And Mark Dotzer, the economist, Mark formerly with the Texas A&M Real Estate Center. I think everybody knows that Jet Lending has a close relationship with Dr. Dotzer, Dr. Mark Dotzer. He threw up a chart that I'd never seen before a month or so ago, and it talked about building permits. And basically the chart, paraphrasing, the chart said 1959, 1960, 1961, heck, we're talking 60 years ago, there were approximately 1 million building permits issued in the United States 60 years ago. Now, fast forward to 2021, there's going to be approximately 1 million building permits issued in the United States this year. So we got the same number of building permits for single family housing today as we had 60 years ago. But the population, and I looked this up the other day, we're almost exactly, I'm pretty sure I'm right about this, double the population today that we were 60 years ago in the United States, but we're still building the same number of houses. A la shortage of single family residences will continue.
Well, maybe we got to cap off like what the Chinese did back in the day, have one kid per family. Control the population.
I don't think that's going to happen anytime soon. I know what causes that. That ain't gonna happen.
So let's break it down and talk about each area of real estate investing. So we got the wholesale, we got the flip, right? We got rental, and we can break it down into long-term and short-term. And we also have retail sale, because at the end of the day, some people also retail what they buy.
That's right. Let's talk rental versus, hold versus sell. I think that's probably the most educational topic and the one people probably want to hear the most. We've been saying in this business a long time. I didn't invent the term, but you flip for cash, you sell for cash, you hold for wealth. And it has a nice ring to it, but it is so basic truth. I mean, it's the basic premise. None of us can hold the guys and girls out here that do a large volume. None of us can hold them all. I mean, you run out of money eventually. You can't hold them all anyway by yourself. So you hold what you can, and then you sell what you need to for your cash flow to pay your bills. To pay the overhead, the marketing costs, the vehicle costs, the phone costs, the office costs, office staff. It takes money to run that. So the only way you're going to really generate that in our business is sell houses. That's your payday. And we've lived it for, 23 years now, flipping houses. And it's a good payday most years.
And Eddie, I want to add another thing to that is also hold what, the good inventory, like hold the cream of the crop, and then sell all the other stuff, the problems, the issues, because you don't want to hold the issues.
Well, some of us still do. I guess I still do to a certain extent. I got a lot of houses in some rougher areas. Here's another way to look at this. A house in a rougher area, a lot of times, because we put them on Section 8, they cash flow big time. but they don't normally appreciate at the rate at the maybe some of the suburban houses. I have found that if you hold a house in a area where there's a top rated high school, not that the middle schools and elementary schools are not important, but the high schools I feel like are the key. If it's a top rated high school, that house will always stay rented and that house will always appreciate. So I learned that a long time ago. So I like to do that, but it's also good just to have a mix. Now I said the house in the rougher area don't appreciate as much, and that for 23 years.
That's changed this year, didn't it?
Yeah, well, it's changed a couple. Yeah, you're right. It changed a couple of years ago, actually. Those houses used to not appreciate. They didn't appreciate for a long time, but in the last 24 months, 36 months, they certainly have. And what we used to pay $20,000 and put $30,000 in it and sell it for $90,000, that house now you pay $80 or $90, $100 for it and put $40 in it and sell it for $170, $180, $190. These are Houston numbers. I know some people be listening in other markets, but for comparison, that's a Houston number. So, but back to the grand scheme of things on this holding, I am an absolute walking billboard for appreciation. We still own a lot of rentals. Some days they're such a pain. They really are. But then when you look at, the appreciation that we've gained over time, it is phenomenal. And let me touch briefly on what's happened in the last 36 months. Let's talk 2019, 2020, 2021. In 2019, I think I've got my memory right here. In Houston, these are not Eddie's numbers. These are Houston Association Realtor numbers. The average appreciation in Houston was somewhere around 12% for single family housing, double-digit appreciation. Now, that was 2019, around 12%. 2020, we hit 18, I think it's actually 18.2 is what the report says, 18.2% appreciation for Houston. It's the first time since I've been keeping track of this thing that Houston, Texas hit back-to-back years of double-digit appreciation. Well, here we are in December of 2021. We're finishing the year. When the numbers are released, we will hit that for the third time in a row. It's going to be again approaching the 2020 number around 18%. So we're going to go 3 years. Just run the numbers. If you had, let's just say you had 10 houses and combined they were worth $1.5 million, that'd only be $150,000 each. And tack on 12% and tack on 18% and tack on 18%. Run the numbers. It's a big growth number, and I'm getting long-winded on you, and I hope I'm not getting off track with you here, but this holding properties and flipping properties is the real deal these days, without question.
Well, yeah, to piggyback on what you said, here's an example that I have, right? So I bought this property in 2019, and at the time, the bank appraised it at 194. Fast forward, recently, a few months ago, it was appraised at 250 when I did a refi. So that's, over $50,000 in appreciation. And that's what, 25%?
Yeah. I mean, it is, I told this story. When I was at that real estate conference last week, it was in New Orleans, and I spoke several times. I told this story. When I got in the business in 99, I remember thinking, dadgummit, I missed out on this appreciation. All this appreciation I've been reading about for the decade of the 90s. I missed out on it because it's June of 99. I'm just now getting in. Why didn't I do this 10 years ago? I missed out. So here we go. Let's fast forward 23 years, that I've been in this business, and we're coming off 3 years in Houston of record appreciation. Like I said earlier, 12, 18, and what appears to going to be 18 again, or 18 or close. Record-breaking appreciation time period for us. And go back again, my thought in June of 99, I thought I'd missed out on it. And it's crazy what's happened. And it's good news for those of us that hold a large rental portfolio, because it doesn't appear that we're going to stop this anytime soon.
Yeah, I follow Dr. Dawson just like you, right? And I was at a conference, and he said he bought 4 rentals last year. And he said, I quote, you think the price is high, just wait, it's going to get higher.
Yeah, I heard him say that, and I love to hear him speak. He said, if you think, it's exactly what he did. If you think it's high now, just wait. There's a couple other gurus around. I know that put a lot of stuff out there that use that saying a lot, and they are correct. It's a good time to be doing what we're doing, and just think about the growth of our industry for a second. The emergence of the flipping this house shows and HGTV and all of that. It made it really, really cool to be in our business, because I remember the first 5 years in this business, or maybe the first decade, the word in real estate investor in certain communities, you were looked at like you were Darth Vader. You were the dark side. People thought you were dirty if you were a real estate investor. Now in this industry, it's more of a cool thing, and it's more of a trendy, I guess would be a good word. It's a trendy thing to be a real estate investor in today's world. Your thoughts on that, V, if you don't mind?
Yeah, well, back when I first started in 2014, I was nervous to say I'm a real estate investor because, I didn't want people to not take me seriously,
Mm-hmm.
But that has completely changed in the past few years.
Yeah.
You're right.
Well, yeah. And FHA came out with the anti-flipping rule, years ago. And again, you can look at it any way you want, but when you say anti-flipping, and that's the name of the rule that FHA, that is a negative, slanderous type heading on you, whether you want to admit it or not. When they say anti-flipping rule, they need to change. It's still out there. They need to change it. But that, along with, I can remember thousands of conversations with a real estate agent representing a buyer on one of my houses, and the question would come out of their mouth, "Oh, is this a flip house? Oh, is this a flip? Oh, is this an investor selling this?" It was you were met with automatically 98% of the time a negative question or negative comment, and that's totally changed. And I know that wasn't probably our intent to talk about that in this podcast, but it is very interesting, isn't it?
Yes, it has. And I remember that now, just going down the memory lane about how real estate agents would ask you that right away coming out of the gate. But now you don't hear so much of that anymore.
No.
Like they never, almost don't ask, is it a flip? I think they mainly ask, why doesn't it take FHA when you sell a house retail? And that's a different reason. Yeah. This episode is brought to you by Buzz Vacation Rentals, a premier property management company in Houston and Galveston areas. Buzz Vacation Rentals specializes in managing short-term rentals the right way. Give Buzz a call at 281-549-8432 to learn more, or check out their website at listwithbuzz.com, and that is listwithbuzz.com. Now, back to the Real Estate Ballers Show.
Hey, here's a question they ask now. They don't ask, is it a flip? They don't ask, oh, is this invest? They ask this, how do I get in that business? How did you get your start? That's what they ask now. And you laugh, but it's true. And, we're having a conversation that was unplanned. We wouldn't plan to go down that path, but it's very interesting and it's very true how this has changed to such a positive manner, the way our industry is perceived among these mainstream real estate people out there.
I agree, but I can't say that for the state of California.
Well, we're not in California. I'm sitting.
Yeah, we're not going to go down that path today.
Yeah. Now, last time I looked, my truck had Texas license plates, so we're good.
I think we're in good shape. Okay, so rental, if you can, buy and hold them, right?
Yeah, if you can, yeah. And I would say, if you're new starting out, you always want to stabilize your cash position. If you're light on capital, if you're light on excess cash, if you're just light on that area, and hell, I'm not making fun of anybody because we all were at one time. I'm not above saying we've had lean times. We don't have it as much as we used to, but we did. So, how much cash do you need? I always looked at it like, and I really did honestly do this. I always looked at my cash position and I looked at how much outgoing I'm going to have for the next 6 months. And then I would say to myself and look at it on paper, if I don't get another penny of income in the next 6 months, I have absolutely zero. Everybody quits paying rent. I don't get any houses sold. Do I have enough cash in the bank to make it 6 months? And if the answer to that was yes, I felt pretty good about things because I knew I wasn't going to go with zero revenue for 6 months. You would, somewhere along the way, you're going to generate some revenue. But if my answer to that was no, I don't have enough money in the bank to pay everything for 6 months, I would not take on another rental property. Okay. I would continue to flip and sell everything that I had an opportunity. And when I got my cash reserves built up, that's answer to that same question again was yes, I have enough money to pay everything for 6 months. Even if I don't get another penny of revenue for 6 months, then I would start to feel pretty good about adding to my inventory. And that was just my Eddie Gant own little rule I come up with, but it's probably not a bad one to follow.
So in 2020 and 21, we were hit with the pandemic, and a lot of landlords became fatigued because of the evictions moratorium. Do you think that's going to affect the rental coming in 2022?
I don't think so. You never know. I don't think so. Most of that's kind of done with right now. But you just don't know what's going to happen. I mean, when this deal hit us, and I call it, I think it's Monday, March the 9th of 2020. I call it COVID Monday. That's when everything hit. That's when they shut down college sports. They shut down the Houston Rodeo. They shut down the NBA, I think it was. Everything come to a screeching halt. And I'm going to tell you, I thought it was going to get really, really, really bad for a while in the real estate world. It slowed us down for March and April. And then we started hitting record-setting numbers in May in Texas for sales, and it hadn't checked up since. I didn't see that coming, and it's a combination of supply and demand and interest rates. It's really not much more complicated than that. And the three economists we all saw last week on the video feed basically said that, supply and demand and interest rates are at record lows. Let me give you some numbers here. And this ties into the holding of the properties. Used to, if an investor that did not show their income was able to get any type of financing, they were happy. So then you started to see products come out there for investors not having to document their income for the underwriting. And they started getting rates at 7 to 10%, and they were pretty happy with that. What would you say today if I told you, as an investor, if you have really, really good credit, you can get those interest rates? You can get them in the high threes. Now, that's a little more difficult, but I'm going to certainly say middle fours to high fours is almost commonplace for somebody with a 680 credit score, an investor holding rental property, 30-year fixed, no balloons, 680 credit score at about probably a 75, 80% loan to value, and getting those loans done every day in the fours. What would you have thought of that 3 years ago, 4 or 5 years ago? You would have said, ain't no way that's ever going to happen.
Yeah,
well,
I'll call you right a
fool. Yeah. Well, it's happening right now, and you and I both know it because we're in this. But the majority of the people out there, I don't think know that. I mean, some people do, but the majority, I don't think, realizes that. And keep in mind, that's with not showing your income. They're going to, let me tell you what they're going to underwrite on real quick. What we underwrite on credit, loan to value, and debt service coverage ratio. That's your underwriting criteria for these loans. And investors, Wall Street has learned that that's a safe loan. And that's the reason you see so much capital being poured into it.
Can you briefly explain the debt service ratio? And then I got one more questions on rental, and then we move on to another area.
The answer, can I explain debt service coverage ratio? The
briefly.
No. Yeah, of course. Debt service coverage ratio. Most of the time I'm going to use a number of a 1.2. What 1.2 means is the best way to explain it is with an example. If your property rents for $1,200, then your max payment can be $1,000, all of the 1.2. Okay. Sometimes you have to work it from the other side. If your payment is going to be $1,000, well, then you have to be able to get $1,200 in rent to qualify. So you can work it both sides. You normally know one and you solve for the other. Okay.
So payment, you mean premium, interest, tax, insurance, HOA?
No, it'd be principal, interest, taxes, insurance, and some of them will add the HOA into it. Some of them will, not all, but the HOA is usually small. okay, on a single family house. Usually it's small compared to the others. So principal, interest, taxes, insurance, maybe the HOA added in, that totals all to $1,000 a month. Then at a 1.2, you got to be able to rent that house for $1,200 in order to qualify for your mortgage.
Okay. So another hot topic in the rental space is short-term rentals, or some people may call it Airbnb. What's your thought on that?
Well, I have two right now. Like to have more. I'm not huge into it, but I usually move a little slower into new stuff anyway, and I'm gradually going to get there and have some more. I am looking to add to that right now. My comments are as follows. Number one, it's not going away. That's for sure. It's growing in leaps and bounds. And I guess the Airbnb and VRBO, that's like saying Coca-Cola and Winnebago to a certain extent. It's a broad generic term it's really one individual, company. But now because they were the first and the biggest, they call the whole market Airbnb now. I don't like to say it that way. I call them short-term rentals. I don't even use the word vacation rentals, because most of the people renting my short-term rentals are not on vacation. They are needing that property for a short period of time for another reason. But it's not going away. It's growing. 3 years ago, you couldn't hardly find any lenders that would stand up in a room and say, we loan on short-term rentals. Now, essentially everybody who loans on rentals, period, is loaning on short-term rentals. And the reason's pretty simple. They have discovered that is a safe loan, that is a safe investment for the lender to loan on them. They don't go bad. So why do they not go bad? It's really simple. The people that own them are making their payments. The people that own them can afford to make their payments. The people that own them are getting income from the properties. So it's not going anywhere. It's growing. And I know you're part of some large national associations, and the membership of those organizations is, I'm assuming, growing by leaps and bounds. The only negative I see with them, it seems like every time I get a email now from a wholesaler, regardless of the property,
it could be in the hood, and they stick a short Airbnb. Yeah,
it could be in the biggest war zone on the back alley and in horrible condition with no parking, and the wholesaler is going to say Airbnb, or they'll say short-term rental or vacation rental. They put it on every house, and I don't even pay any attention to it anymore. I like them to be truly nice properties in a high-demand area, and I only have two. I do. I've only got two, but they're performing well, and I plan to get more. From a numbers standpoint, they perform very well. The upfront cost was a little high to get in them due to the furnishings, but after that, they rock. And I will say this, based on feedback that I get, they're being maintained better, or I would say even way better than my long-term tenants. Every time we have a long-term tenant move out, we're painting and carpeting. Every time. Sometimes replacing the stove. We haven't had to paint our short-term rentals yet because they're very well maintained, not only by the guests, but by the management company.
I totally agree with you on that, because your tenants, your long-term tenants, stay there for a year, 2 years, and hopefully, several years, and you'd have no way of knowing how they treat your property. I mean, you
that's
do
right.
to some extent, but you don't detect the problems right away.
That's
versus
right.
On the short term, they're there for a weekend, they may be there for a month or two. So any issues you can detect right away, and obviously they pay a lot of money, so they won't mess up the property.
Mm-hmm. I said this the other day, with a short-term rental, the carpet's getting vacuumed anywhere from every couple of days to every couple of weeks.
Yeah.
Okay. It's getting vacuumed. It's getting clean. I have moved people out of a rental that they've been there a year, and it's never been vacuumed since they moved in. So that analogy right there, that example right there will paint the picture for you on your condition of your property over time.
Okay. That's good. So great outlook in 2022 for rentals, long-term and short-term.
I mean, it comes down to, we talked many times using the word demand. and these interest rates. Right before we got on this call, I sent a message to one of my bankers. He refied a 40-house package for me a year ago. Well, I've got a few more for him, and I sent him an email right before we got on here, and I said, hey, do you want them? I don't know if he's responded yet. I'm assuming the answer that's going to be yes.
Probably.
But I refied a 40-house package at 3.75% last year. That's not bad.
Not bad at all.
I had one of my buddies I went to dinner with 2 weeks ago. He refied not with the same lender as I did. He refied, I think he said a 15-house and a 20-house package for 35 houses, and he refinanced at 3.49. Great for him. Kind of made me mad because he beat me by a quarter a point plus on his deal. So he kind of rubbed it in on me a little bit, but think about those numbers.
You don't like it when anybody beats you, do you?
No, I don't. I'm very competitive.
Yeah.
A lot of people, you can outsmart me, but you're not going to outwork me. I've had that motto for 23 years. I am slowing down a little bit. I turned 40 this year. I turned 40 just a couple of weeks ago.
Happy birthday, Eddie.
Yeah, I hear you.
Okay, so with the market being so hot, right, how would that impact the wholesaler, the flippers? Because, they got a couple of challenges. It's harder for them to buy the deals. They have to offer more to get the deal. And then the cost of contractor, labors, material have been rising 20-30% increase. How do you think this whole overall will impact that side of the business?
Well, the general public is not totally stupid. And what I mean by that, I'm joking, a little bit of a joke. Don't make anybody mad. The general public, for the most part, knows, even if they're not in real estate, they know because they read the paper or they read the internet articles. I guess they don't read the paper as much as they read the internet articles, and they watch the news and CNN and the other crazy things out there. But they basically have a knowledge to know that it's a seller's market. It's a hot real estate market. Okay. So that's going to make them harder to get. There's just no need to say that that's not the case. Good deals are harder to find. But here's the but. A very smart man 23 years ago taught me something I've never forgot. And I fully believe it today. It may change a little bit, but the base premise is still true. He told me, regardless of market, whether you're in a sales market or a buyer's market, the distressed market for real estate is 2 to 6% of the overall market. 2 to 6%. In Houston, we sell, the market's basically 9,000 houses a month in Houston right now. So 2% of that number is 180. 6% of that number is 540. So if you use that rule that I learned 23 years ago, that means somewhere between 200 and 600 houses are out there being sold in a distressed condition. And I believe that to still be true. It's a reasonable number. I believe it. And those are the houses that are outside of this box of mainstream that's on MLS and moving like hotcakes. These houses are beat up. We have a saying, looks bad, smells worse. They can't necessarily always be sold out through the normal, way of selling houses. There's an economic or financial situation going on in that household that makes that seller extremely motivated to just sell it the easy way. Some of them are inherited, and the kids, due to whatever reason, their location geographically to the house, or their emotional stress of not wanting to deal with it. There's a lot of reasons why people sell a house to an investor for cash if that investor can perform and close quick for a discount for convenience to be done with it.
I know you and I belong to a group called Homevesters, and just based on your 2 to 6% number, I was doing some quick math. I think we buy about half of that. We have about half of the market shares in that. What do you think?
Yeah, as a whole group, we're definitely the leader. I don't know if the 50% probably is. I don't know. We are definitely the biggest one in there. And this is not a sales show for Homevesters, but if somebody wants to get in the system with the best leads, then you need to contact us about being part of Homevesters. I'm 23 years into it. I'm not going anywhere. I'm going to be in it for my 24th year. If it wasn't a good decision for me, I wouldn't be doing it. So there you go for that. But back to the first question was, it is harder to get them, but that 2 to 6% of the market that's distressed has been there for 23 years. It was there this year. It was there last year. It was there in 2019. It's going to be here in 2022. You just got to figure out how you're going to tie into that 2 to 6% of the market so you get yours. And there's ways to do that. Mainly spend a little money marketing yourself through, whether it be Homevesters, if you're a member of Homevesters, or if you're an independent, which is fine, through whatever market media you want to spend your money on. But those are always going to be there. I learned a long time ago, it's amazing what someone will sell you a house for today that they really don't want if you can close quick. That phenomenon shocked me 23 years ago, and it shocks me today to a certain extent, of how some people will sell you a house at a heavy discount if they really don't want it, and you can perform today.
Yeah, thanks for sharing that, Eddie. Let's talk about retail. Do you think that buyers are running into what I call buyer fatigue because it's harder to buy and then they end up having to offer over list price just to get the deal under contract, and they're easier to back away because they feel like they overpay, and then when they come to first signs of problem, they back off. Do you see that problem too, or?
I think so, but here's my little asterisk on the end of that. But it don't really matter to the seller because somebody else is coming right behind them that will buy in today's market. It's that high. We carry about 6 weeks of inventory in Houston right now, maybe 5 weeks. You know, if your buyer has fatigue and feel like they're overpaying and they go away, you probably got another one right in behind them. That's what I seem to experience today.
You think
did that make sense?
It does, but you think that's applied to big market and small market? Because I noticed that in Houston, you know, it's more popular that the buyer will submit over list price and commit all the way through, versus in small town like Corpus Christi, where people just back off quickly.
You know, I don't know. I wish I had that answer for you. I'm not sure that I do. Corpus Christi is a small market compared to Houston, but I wouldn't categorize Corpus Christi as a small market. Not when you come from small town Mississippi. You know, that's a small market. Grenada, Mississippi is a small market. Corpus Christi's got 500,000-600,000 people down there. So it's a little bit relative. I see it a little bit differently. I don't think you go small market in my mind until you're under 100,000 people. So I would still categorize corporate. And I'm not trying to disagree with you. It's just a different opinion. As far as I know, and you know it better than I do, I think Corpus is still pretty darn good, isn't it?
It is pretty good. It's still a very good market, and it's sort of untapped, you know. It's not as competitive as Houston or San Antonio or Austin.
Yeah. And of those, Austin is the one that's still on fire. I'm pretty sure I'm right on this. Austin still has less than 1 month of inventory.
I think the number I heard is like 2 weeks or so or something. That's the last number I heard.
It was 2 weeks. I don't know if it's still there. It was there. But regardless whether it's 2 weeks or 3 weeks, it's still hot.
It is.
I mean, there ain't much difference between a 2 week inventory and a 3 week inventory in a place like Austin, Texas. That's for sure.
Yeah, for the audience that are listening, I love to hear feedback from you on, you know, if you're in multiple markets and if you see any variation between big established market versus small market. I love to hear feedback from you. Yeah.
The thing we can amplify here a little bit is going back to that low end market. We do a lot of loans in San Antonio and we do a lot of loans in Corpus. The values of the lower end in those two markets, and that's going to be the same across the states, is the appreciation and the growth of those numbers over the last 24 months is just nothing short of shocking and amazing. And you just look at it and go, wow. And it's not a bubble. It's not a bubble that's going to bust. And that's because there's no inventory. So in other words, a house that appreciated from 100,000 to 160,000 in the last 2 years, 3 years is not going to just bubble pop and go back to 100 because there's no inventory. And that's what the economists were really, really driving their point. It can't be a bubble because there's no enormous new inventory coming that's going to cause it.
That's a really important point. Yeah, that is a really important point for an investor who looking to get into real estate. Now, one last question. So we know stock didn't do too well, or I mean, it's a lot of fluctuations, and which then, you know, and some other investment vehicle. So then that drive a lot of people to get into real estate, which caused the market to be even more competitive. What's your opinion on that?
Well, I think that is a factor. Honestly, I think the reason the growth of our industry is more media from the HGTVs and all the shows that's on TV, and quite frankly, large REITs, large companies. Well, Jet Lending is not a large company. We have a large presence. Our free education out there putting on very large meetings. You know, the Jet meeting's the biggest out there once a month. But it's not just us. There's other organizations doing the same thing. The public and group and association promotion of the industry. I mean, you can't hardly go anywhere in Houston without hearing. You hear about the Jet meeting. You hear about the Mr. Texas Real Estate meeting. You hear about whoever's meeting going on out there. And you just can't get
and the
around
Real Estate Baller
about
podcast.
The Real Estate Baller podcast. Exactly. There wasn't a market for your podcast 10 years ago. There should have been, but it probably was. It certainly wasn't 15 years ago. But it's all of these very, very good, sound organizations. Some of them do it for their notoriety. Some of them do it for a fee. Some of them do it to sell their service in another area, but it doesn't matter. 90% of them are good people with a good message promoting the industry. And then I'm going to tell you, here's something we ain't talked about, the emergence of the millennials. It's the largest group out there. You know, 10 years ago, it wasn't even that long, 6 to 10 years ago, we sat right in front of group after group after group after group and said, millennials don't buy houses.
That's
millennials rent. Millennials travel. Millennials do this. Well, guess what? 2022's coming. Millennials have traded in their skateboards for BMWs, and they want backyards because they're having babies.
That's right.
Okay. And they're, I guess, maybe trading in the skateboard for the BMW now for the soccer mom van. Okay. The millennials are the new soccer moms, and they want backyards. There are predicted to be, and you don't hear this everywhere, but you're going to start hearing it. Millennials are going to be the biggest house purchasing group for the next decade.
I heard that too.
Driving this.
Yeah.
And millennials have never bought as a group before. They've always rented. But that is changing. It's in the embryo stage of the change. And you and I both heard a very high level marketing firm talk that message last week, did we not?
Yes, we did. Uh-huh.
So millennials are now buyers where they've never been buyers before. Now, what does that do to inventory? Puts even higher demand on an already stressed demand market.
Yeah, because
I usually don't use big words like that.
Yeah, that Mississippi educations don't get very much, does it?
You know what? You're right about that.
So you got hedge fund coming in, you got private money coming in, you got millennial buying. So real estate's all good.
I'd say it's 98% good.
Yeah. All right, Eddie. So 17 houses bought and a thriving, easy lending company. What's next for you?
Not 1,700.
I said 1,700.
Oh, I thought you said 17.
You just want to emphasize on the number. We good. So what's next for you?
I'm just going to keep doing what I'm doing. I mean, I have learned to grow with the times more than most people give me credit for. I have learned to hire people that are strong where I'm not, mainly technology. I have some very good people that are, help me in that area. So I believe this, and I said this is going to contradict what I said a little bit. I said, keep doing the same. What I mean by that is I'm going to keep investing in real estate. But I'll tell you this. Let me tell you, I don't have a lot of hardcore philosophies, but I do have one. Well, I have more than one, but this is the main one. You may have heard me say this before. I live my professional life with this. And the saying is this: there is no staying the same. I repeat, there is no staying the same. You either get better or you get worse. And I heard that a long time ago, and I'll tell you in just a minute who said it. It's a famous person said it, but I heard that and it stuck with me. And I truly do live every day of my work week, which is usually 8 days, by the way. And I live every week, every month in my professional life with that. There is no staying the same. You get better, you get worse. I choose that we try to get better every day. Let's try to be better today than we were yesterday. Let's try to be better next week than we were this week.
Hard to tell, Eddie. Hard to tell.
The person that said that was Jimmy Johnson, coach of the Dallas Cowboys. And I've never forgotten it.
Okay. All right. So here's the question I ask every guest on the show. What is the one thing that people might be surprised to learn about you?
That I'm just a little old country boy from Mississippi that moved to Texas when he was 20 years old, and I'm still here.
Well, that was a good move.
Yeah, not bad. Not bad.
Last questions, Eddie. How does the audience get in touch with you?
Eddie, EDDIE at jetlending.com. That's Jet Lending. That's probably the best way.
Thank you for watching the Real Estate Baller Show. If you find value in this show, please give us some support. Give us a thumb up, subscribe to us. You can also share this episode with a friend or give us a shout out on social media using the hashtag REBallers. Lastly, leave us a comment below. Let us know what you learned from this episode, what's working and what's not working for you. See you next time.